Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Brown and Brown stock. This one came in by request down in the comment section of one of my other videos. If you have a request, just put it down in the comment section. I'll get it on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500 like Brown and Brown is, I post those on YouTube for free, and most of the rest I post on Patreon. And those links will be down in the description. Also, if you join the $5 Patreon tier, you can get a big discount if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. Additionally, I do have a 25% off affiliate link for FastGraphs, which you'll see me is the graphing service that you'll see me use here on the channel a lot. And that will be down in the description as well. If you've never used FastGraphs before, you can use that link and get the discount. All right, so Brown and Brown. As always, this is not individual investing advice. This is just how I analyze stocks. I'm kind of glad somebody asked me about this one because I did track it in my spreadsheet, but I never really looked at it. I just had kind of looked at the numbers. And it's always kind of escaped me, mostly because they had kind of a low earnings growth period here, which was up until 2020. I would usually start my kind of historical earnings growth analysis back in like 2006 or so. And so their earnings growth was slower, I would say, leading up to here, and then it's kind of been accelerating. So when you have a historical earnings growth that's slower and then more recently it's accelerating, usually I'm going to be a little behind on that. Unless there's like a downturn or something like that where I can come in and buy. And that hasn't been the case with these guys. They've managed to continue to really accelerate, not every year, but for the most part, accelerate earnings growth. And so to give an example of that, let's look at, now they have had periods of faster earnings growth back in the early 2000s too, but let's just look at what I would have maybe been looking at. We'll go from here to let's just go through 2019 or so. So if we just use the FastGraphs numbers here, so during this period they grew earnings like 6.37%, and it probably would have even been a little bit lower for me because I would have included this little downturn in earnings. Now there are a couple things that I would pay attention to here. These guys are an they're called an insurance broker. Usually with just insurance companies in general, what I'm looking, and for almost any business actually in general, I'm looking for what these earnings patterns are. And sometimes with insurance companies, you'll see every now and then they'll have like a big like claims year. So everything will be going along just fine. And then they'll have a year where they like totally lose money, just in random, just kind of happens randomly. And so I really like to look at these big, long data sets because that gives me an idea of what kind of risks they might be taking on that only come around like occasionally, right? And I like to account for those. Well, with these guys, they say in there, I read part of their annual report, at least the business-like description part, because I wasn't sure exactly what they do. And it's pretty complicated, but it seems mostly they make money off of like fees and then profit-sharing arrangements with insurance companies. And while they do have some underwriting risk, they say that they try to limit that, and they're kind of selectively the way that they do business, basically. And when you look at the historical earnings, that actually, the evidence is there that that's true. While they did have earnings declines, they weren't sudden, they weren't sharp, and they weren't deep. And they kind of had a period where earnings growth was growing 6 or 7%, but it wasn't super volatile or anything like that. So from what they say they're trying to do, if you look at their earnings, it looks like that really is what they have been doing. So that's good. So we don't have necessarily the same type of insurance risk that we would have with like a just straight up insurance company. I think that's a fair assumption to make, or a fair conclusion to draw from what we see. Now, if we go to the more modern time period here, this is where things get interesting and probably why I've never been able to buy the stock yet. So you see their earnings growth during this period is more like 16%. See, wait, actually, let's move this my fast graph. Are they going to move all of them? We'll get it set up right eventually. I think I want 2016. And the time period you choose to measure will matter when it comes to like, so yeah, so we're looking at like 17.5% earnings growth. So that is way faster than what they did the previous like 10 years. And that accelerating earnings growth is really done well with the stock. Like if you went back here and you look at now, you get like a 25% CAGR. So it's just been fantastic. A couple years ago, these guys were added to the S&P 500. I was just doing some research on newly added S&P 500 companies since 2020. And these were one of the, other than a couple semiconductors that I haven't looked at all of them yet, but this was one of the few new S&P 500 additions that has actually produced positive returns that are pretty decent. So really everything kind of trending in the right direction for these guys. The question is, I think, how long can they keep growing this fast? So there's always a limit to like how long you can grow that fast. Analysts are looking more like single-digit earnings growth after this year. So a big, huge year this year, and then things kind of level off. So we have to kind of, make a choice as investors of what sort of assumptions we want to make. Do we want to assume that earnings growth is going to grow at 17%, or before leading up to COVID, it only grew at about 7%, right? So there's a big difference in what you'd be willing to pay for a stock. But overall, I think the quality's there. It's just really what do you want to pay? What's a good price to pay? And that's what we'll look at here next, depending on what kind of assumptions we want to make. So I'm going to do this two ways to kind of cover both ways to think about it. One is we just take I controlled for their buybacks, or actually they didn't have very many buybacks, but they did have 1 year where earnings were down a little bit. So when I control for just, I think the buybacks were only like 2% over this time. So this number isn't exactly what the fast graphs, but it's almost exactly the same. So this is just my straight up going by the numbers earnings growth, but it can work in the opposite way that, before I would have underestimated the earnings growth because I was looking back in time and kind of extrapolating that forward. Now, when the earnings growth is this high, I think it is possible to take too high of and too optimistic of a view with earnings growth from here. But I want to go ahead and use just the raw number here first, and then kind of I'll show you an adjustment that I'm making right now. So this is the raw 17% growth rate. If we look at the earnings yield using that, so PE ratio, I have about 25 using forward earnings. Right now it's actually like 28, maybe actually a little less than 25. So I get an earnings yield of 3.62%. So what that means is if you bought the whole business for $100, you would earn $3.62 that first year. If you pull forward the 17% growth, you would earn $4.24 that first year on your $100 investment. And then if that grows at 17.31% each year, this is the $3 or the $4 growing, not the 104. If that grows at that 17% each year, what I want to know is what would you have after 10 years? And it looks like you'd almost double your money. You'd earn $96 on your $100 after 10 years. And then I say, okay, well, what kind of CAGR does that produce? What kind of compounded annual growth rate? And it's about 7%, which is much cheaper than the S&P 500. But we did see that after this year, analysts are expecting earnings growth will slow down. Now, maybe they'll be wrong and they'll understate it. Most stocks right now are about 5.5% CAGR that are in the S&P 500. So we could look and see kind of what the market's pricing in with different growth. Like 12% growth rate is what the market's pricing in. That's probably more reasonable, honestly. I think before I went and ran the numbers again before I made this video, I had 12.3 as my estimate. But I wanted to put this raw number in just to take a look at what the actual, if we were able to extrapolate that growth, what it would actually look like. So, and that's just I think that's going to be a judgment call with a business like this. I think they're 30 billion now. Let me see. 25. So they're a $25 billion company, maybe 27 if you include debt. So that's not like super small, but it's not like super huge. But you do have to think in your mind, look, it's not small. How big is their market where they can realistically grow this much over 10 years? I feel much more comfortable with probably that 12% number. And if I ever get to the point where I'm not using a recession assumption, then I might change that. I'll probably change that to 12 or something close. I mean, we can look and see what the numbers will be then. But I probably, just out of conservatism, would lower this. But if you take these assumptions, that would put my buy price at about $75 a share, $74.40. That's only about 16.74% lower than where the stock trades right now. So if they can pull that off, they're pretty close to being a buy, if they can pull that earnings growth rate off. But right now I have my recession metrics on. And if I go back and I use the 2008 recession data, drawdowns and things, then it's more like a $46.22 buy price, more like 48% lower than where it is now. So and that's kind of where I'm standing right now with it. Because this is just, me personally, if a person thinks that we're going to have like a total soft landing and not have a recession for the next 5 years, then might not be worth assuming that there's a recession coming. But if we go back to this period right before the last recession, these guys peaked in 2006 along with the housing market with a 31 PE. Right now I think they're 28 PE. So we've seen them grow at 16, 15, 17%. That's what they were growing going into the Great Recession. And the valuation was very similar to what it is now. So this could be a similar type of setup. Valuation-wise, it looks like it is. And that, especially if you use like real earnings growth. I mean, they've had faster earnings, or because we have more inflation now than we had then. But we see this period where I showed earlier where they only grew 6%. They from 2007, it took them 5 years, basically 6 years. It took 6 years for them to earn more than 68 cents a share again after 2007. So that's a pretty long now, things weren't super volatile. It probably wouldn't have been like super crazy scary. I bet the stock fell like about the same as the market. Let's see. So the stock fell, about 55, 60%. That's about the same as the wider market, which for some people will be I'm used to cyclical stocks, which is normal, like for them to sometimes trade to fall that much. That might be scarier for other folks. But to me, that's just like normal volatility, pretty stable but weak earnings growth, and just this whole digestion period here. It's entirely possible that could happen again. And so I would definitely be willing to buy this stock on a dip, but I prefer not to step in and buy it when everything looks like super great. Because you never know. I mean, it could go on being super great. It could, absolutely could. But a lot of that's priced into the stock already. So now back in 2023, let's see, that was only a little over a year ago. We had more like a 22 PE, and then the stock was trading cheap because they only grew like 7% that year. Then things are looking more reasonable, but it's just really hard for me to step in and buy like an uptrend. But I really do I'm kind of glad I took a look at it. I like the quality of the business. I would definitely be a buyer at the right price, I think. And I don't know when the market will provide that, but it definitely could. I'd be willing to step in and buy this one. So I'm glad I'm tracking it. I think it was one of the few good additions to the S&P 500 they've made the past 4 years. And hopefully they can keep doing well. So those are my thoughts on this. If you found it useful, hit the subscribe button, hit the like button. And if you have a request, put it in the comment section. And I'll see everybody later. Bye.